Welcome. This is the Q2 recap from Capital Financial Group. Thank you guys so much for tuning in. If you haven't had a chance yet, like and subscribe below, please. We love having followers, and we don't want you to miss any of the videos coming your way. We have a really exciting summer investment series coming down the pike, and it's going to be about 8 weeks long, and we'll want to make sure that gets straight to your inbox. Let's jump in here. Last quarterly review, you will probably remember we focused on something called rate of change. We're going to touch on that again this time. Two of the metrics that we really like talking about here at CFG are GDP and PMI. If you don't know what they are, Google them. GDP specifically was something we focused on last quarter, and what we talked about is how it's kind of rolling over. That doesn't mean it's going down per se or going negative. It just means that it's slowing down. That's the beauty with rate of change. It can kind of signify trends happening. If we can get out in front of those trends, we can manage portfolios more efficiently. But before we get into all that, I want to do a little bit of a recap of what happened here in the United States. The U.S. stock market was the best it has been since 1997 through the first half of the year. It was up 17.3% over the first two quarters. Unfortunately, that's kind of where the good news stops. If you take a look at this GDP chart, right over all the way on the right side of the chart, you can see how it starts to roll over a little bit. It's never perfectly linear, but what we're seeing is quarter over quarter changes that are smoothing out and starting to tilt to the negative. That doesn't mean we're seeing a recession coming. It just means that things are not as good as they once were before. What's interesting is there are a few headwinds out there right now that are driving forces behind GDP kind of rolling over, and those include tariffs and the trade war, two most obvious ones. But one people might not be thinking about is the increase in wages or wage inflation. Wage inflation is something that is positive on the surface for the American consumer because who doesn't want to have more money in their pocket to spend? What's interesting about it, though, is that it can put a little bit of pressure on corporations. Quickly take a look at this chart here. This is a wage inflation chart, but we also did something cool here. We overlaid U.S. durable goods inventories. I don't want to spend too much time on this, but I think it's important to point out that inventories are as high as they've ever been, and there's clearly a positive correlation between the two. Inventories have a tendency to overshoot both to the upside and the downside, the spending power of the American citizen. And I think it's really, really important for you to keep an eye on this, and we're definitely looking at it at CFG to help our positioning moving forward. Another interesting statistic that we've been keeping a close eye on is net exports. But before we get into that, I want to kind of talk about what's happening with the tariffs and the trade war with China. The U.S. is definitely doing some damage to the Chinese economy with this trade war. Obviously, there's a pretty significant imbalance in trade, but we are not getting out of this thing unscathed. It doesn't hurt nearly as much as what's going on in China, but still hurts a little bit. The Chinese consumer is really hurting, and they can't buy as much, and they are the largest consumer of American-made products. I know this seems a little counterintuitive, but if we take a quick look at this chart right here from the St. Louis Fed, this gives us a really good idea of what's happening with our exports. Trump has made a huge point on how he would like the U.S. to have a more equal trading relationship with other countries. But if you look at this chart, it shows that we are actually at more of a net deficit than we ever have been in the past. On the bright side, China has agreed to purchase additional American goods. We have a bit of a détente with the trade war, kicking the can down the road on that whole thing. Moving on, I promised you PMI. Now we're going to talk about PMI. We were talking about how the rate of change was kind of rolling over on that last quarter. And what we're seeing right now, just as of this week, we saw a new print 51.7 on PMI. If just for review on that, if PMI drops below 50, that means we're contracting. Manufacturing will be going kind of negative on a relative basis. This chart shows what's going on over the last few years. There's always peaks and valleys with this stuff, but we are kind of getting to a turning point right now with earnings having incredibly challenging comps moving forward and companies trying to find ways to make money late cycle. I think it's real important to point out what's happening with the S&P 500 earnings relative to what they were doing this time last year. If you guys remember, summer of last year, we were really hitting our stride. The tax cuts were really starting to show up. There were incredible amounts of share buybacks from U.S. corporations. Take a look at this chart right here. This is the S&P 500 earnings per share chart denominated in U.S. dollars. We were really starting to spike last summer, and you can see that right here on the right side of the chart, and then boom, coming back down to earth. Something people don't talk about all the time is how important comps are, and we have incredibly challenging comps to beat over the next couple of quarters. This is how an earnings recession starts. It's important to point out that earnings recessions do not mean we're going to have an economic recession. But what could mean we're going to have an economic recession is a yield curve inversion. Let's take a quick look at this chart here. This is the 10-year to 3-month yield curve. It's been inverted, if you can see on the right side. It's been inverted for about 3 months now. That is not a good thing. Let's roll into this next chart here. I want to spend a little more time on this one. This one is a longer period of time showing yield spreads. The same 10-year, 3-month yield spread we were just talking about. Every one of these darker gray little spots you see on this chart is a recession. And if you notice, somewhere around 12 to 18 months after each one of these yield curve inversions, we see a recession start. Is that a little scary because there could potentially be a recession coming down the pike? You bet. But at the same time, we still have time. 12 to 18 months is kind of that target. And history has a tendency to repeat itself, but it doesn't always repeat itself. Now, the depth and breadth of each recession has been very, very different. The million-dollar question, though, is what do you do when you have a recession? What we like to do late cycle here at CFG in our portfolio strategy is we like to focus on bond proxies. Bond proxies have a tendency to outperform growthy stocks in environments like this. And when I say bond proxies, I'm talking about really boring stuff like utilities, like real estate investment trusts, and even some consumer staple companies, like the people who make your tissues or your cereal. The other thing that works in lieu of bond proxies would be real bonds. Like we were just talking about, the negative correlation starts to show itself during periods of extreme volatility, and that's why we are focusing on high quality fixed income through this period. One little less known piece is alternatives. That covers a huge swath of different types of investments, and if you have any questions on what type of investments or alternative investments are in your portfolio, you can always call me. But we are definitely using them now because they provide some solid risk management and volatility management in your portfolios. Another byproduct of a recessionary environment or slowing growth oftentimes is when the Federal Reserve goes to cut interest rates. Interestingly enough, we've been at record highs in US dollar strength, and the Fed is about to cut interest rates at some point this year, which will start to put a little bit of pressure on the US dollar. This has a lot of ramifications. If you see in this chart right here, going back into the 1970s even, we were at a very, very historically high level on the US dollar relative to a bunch of other currencies out there. As the dollar weakens, this will likely help commodity prices and international stocks, especially emerging markets. Before we get to emerging market stocks, I want to talk about developed international stocks. More specifically, I want to talk about the European Union. So far this year, it's been much more solid than years past. The story hasn't changed much from the last video, but what's cool is things are going from bad to less bad, which is good. Let's take a quick look at this EU GDP chart. As you can see, it's slowly accelerating. They're still growing. I mean, there's definitely some laggards, some countries that are struggling, but as a whole, on the margin, they're definitely getting better than they were this time last year. So it's something we want to keep an eye on moving forward with our international exposure. As you may have noticed, our positioning has already started to tilt a little more in favor of international stocks. And we've also seen an increase in exposure to emerging market stocks. So far this year, emerging markets have had relatively good performance, but not nearly as good as the United States or even developed international, but positive nonetheless. The emerging market countries have the most to gain from the US dollar weakening. This chart right here is cool because it shows you the correlation between the US dollar index and emerging markets. They're very negatively correlated, and there's a few reasons for this. But most importantly is the fact that it's easier for emerging markets to service their debt when the dollar is a little bit weaker. A lot of asset managers are already getting ahead of this. Even though the dollar is not weak, we're seeing huge fund flows into emerging market debt funds. It's kind of the flavor of the day right now when it comes to specialized investing. What's cool though is stocks haven't necessarily been that attractive to people, and we're not seeing the same flows. So I kind of think that that's why EM stocks have been trailing developed international in the United States so far this year. We can't talk EM or EM stocks without talking about the biggest emerging market, and that's China. Recently at the G20 meeting, the US and China decided they were going to have a little pause, or they were going to press the pause button rather on this trade war, kick the can down the road a little bit. And this has been a big deal for China because they were starting to struggle a little bit. The US has decided to loosen some of the restrictions on exporting to Huawei, which will be helpful for semiconductor and chip companies. And all the US has really gotten so far is additional agricultural purchases. If this ramps up, it could be helpful for middle America and farmers, but there's no way to know exactly what that means right now because we don't have a deal. Trump is going to need to get a deal to get reelected. Who knows what's going to happen next year, but one thing we know for sure is he's going to have to get a deal. And the deal's either going to have to be with China, North Korea, or Iran, or two of the three, or all three. Moving over to North Korea, boy, it has been an interesting scenario what's been going on there. We had an unprecedented visit from Donald Trump to North Korea this past week, and they actually met in the demilitarized zone. This is something that's never happened. Sitting U.S. president has never gone to North Korea, at least not that any of us know of. But this could be the first step in possibly getting a stabilized Korean peninsula, and that would be huge for both South Korea and Japan. Somebody that we don't seem to have very good interactions with is the Iranian people, or their leadership, I guess. The Ayatollah is not real happy with us. There's a lot of drama in the Strait of Hormuz. We're seeing this start to perpetuate itself into the oil markets. The U.S. is really trying to cut Iran off from the rest of the world again. And just a day or two ago, we saw the EU get on board and say, hey, you guys got to follow the rules in Iran. You can't just go willy-nilly. So we'll see what happens with that. But one thing that's really cool is how all of this stuff is, all of this geopolitical drama in the Middle East is starting to play itself into oil markets. And we're seeing OPEC get together and they decide they want to ramp up oil prices a little bit. So they're going to cut oil prices, or cut production on oil. And if we take a look at this chart right here, this actually shows the correlation between OPEC supply, how much they're producing every single day, and what happens with oil prices. The cuts that they agreed to this last week should really perpetuate strength in the oil markets, at least for the short to intermediate term, and it should put a floor under oil prices moving forward. Dollar weakness and wage inflation in the United States will likely increase demand, and these should be real strong for oil prices. If U.S. production starts to plateau, prices may spike a little bit, especially because we're in the summer driving season. This would be a big deal for both Saudi Arabia and Russia. But what's cool is U.S. oil producers would be big winners as well. So it's good for everybody in the marketplace. Global markets have risen together, at least for the most part, and this is reminiscent of 2017. Employment's strong, taxes are low, and wages are increasing. These are all good things. Moving forward, it's really important for everybody to know and keep in the back of your minds that we are data dependent here, just like the Federal Reserve always says, and data will dictate our positioning here at CFG and our management strategies for your portfolios. International stocks are still looking pretty attractive on a relative basis. Emerging markets are something that we're really starting to focus on even more than we have in the past. And high quality, lower volatility in the United States are all areas that we've continued to talk about and continued to bang the table on. Keep in mind, though, allocations in your portfolios are going to be unique to each and every one of you out there. Every client has a different risk tolerance, different goals for their money. So no two people are the same, and we treat our portfolios in that very nature. Thank you so much for watching our quarterly review video. We really appreciate the support everybody gives us, and we hope that this has been informative. And if you would like to schedule a review, please reach out to somebody in the office or click the link below to get on the calendar. Thanks again, and have a great rest of your summer. So this is how an earnings recession starts. It's important.